I'm Clayton Collins, CEO at HousingWire and your host for the Powerhouse podcast. Today's guest is Bob Broeksmit, the CEO and president of the Mortgage Bankers Association. We focus this conversation on Bob's multiple capacities for leadership in the industry, how he leads inside of his organization, the Mortgage Bankers Association, and then how he leads externally with the members and housing professionals that he serves coast to coast. Bob goes into talking about the recent MBA IMB conference in New Orleans and what we're going to expect in the MBA servicing conference that's just coming up in a few weeks. I love some of his commentary around playing to your strengths and how that applies to some of the decisions that independent mortgage banks are making at this phase in the cycle in Q1 2024. I hope you enjoyed this conversation with Bob Broeksmit, CEO and president of the Mortgage Bankers Association. All right, we're back for another episode of the Powerhouse podcast. Today, I'm joined by Bob Broeksmit, President and CEO of the Mortgage Bankers Association. Bob, welcome.
Thanks, Clayton. Great to be here.
I'm thrilled to have a chance to talk to you again. And we're just coming off of MBA IMB, and I'm at the conference in New Orleans thinking like, all right, I got to get Bob back on the podcast and learn more about him as a leader of the MBA and in the industry. So since we've kind of transitioned this podcast from housing news to Powerhouse, I've taken a lens of really wanting to learn more about the executives that lead big parts of our industry and, kind of how it impacts the people they lead and the parts of the industry they lead. So, Bob, we were talking in advance and you reminded me you're coming on 6 years as a CEO of the MBA, but your history in the industry goes back far greater than that. You experience actually as a lender. And I know that's a powerful background and viewpoint as you lead your organization. So tell us what kind of brought you from being a practitioner in the mortgage banking arena to stepping into this role that you've been leading for 6 years now.
Sure. So I am, like many of my colleagues in this business, an accidental mortgage banker. I didn't go to college expecting to enter this career, and I took a temporary job in 1985 as my second assignment out of college and joined a mortgage lender called the Money Store in Union, New Jersey. And I was literally typing forms and started at the very bottom of the business. And I got hooked, like a lot of people do on this business, where you can learn so much, which is what I did in the first few years, learned how to do all the different steps of mortgage banking and how it's all interconnected, and also do it to do good for other people, which, there aren't that many businesses where you can combine those factors. And so I've been hooked on it for, longer than I care to admit. It'll be 40 years next year. And in terms of how I ended up in a trade association role versus a practitioner in the business, I had been an active member of MBA when I was at Chevy Chase Bank, where I was for 14 years, and including a stint as chairman of RESBOG, the Residential Board of Governors that sets single-family policy for MBA. So I knew the organization as a member, and then when the opportunity presented itself, I thought that I could bring my skills to bear as a practitioner and as somebody who has benefited from all the things that membership in this institution can do, and bring that all together and guide the association. So that's really how I got from being a practitioner to running the MBA.
What were some of like the biggest or most surprising changes of going from being a mortgage banker and working at a depository to like running a nonprofit or a trade organization where the goals are different, I assume?
Yeah, well, this will sound self-serving on the MBA's part, probably, but the thing that I was most surprised about was the depth of benefits that MBA membership has. And I don't think, if you ask the average MBA member, how many employees do you think the MBA has? I don't think very many of them would say 160. And that's what we do. That's what we have, because we are, of course, very immersed in advocacy and policy. And a lot of our headcount is in those areas. But as you know, we put on over a dozen meetings and conventions every year. So we have a significant staff devoted to that. We have a big education department, which a lot of members leverage and get certified mortgage banker designations and help train their employees in all sorts of ways, and other members perhaps don't know about that benefit so much. We have the economics and research function, peer group roundtables, all those sorts of things that Mike Fratantoni's team does, industry technology. We have MISMO, we have our Open Stores Foundation, and there's just so many things that MBA does on behalf of its members. And in fact, we have a whole team, we call it the M team, short for membership team, that helps members understand all the things that come with their membership. So that, I suppose, was the biggest surprise for me. And in terms of your question about a nonprofit, yes, it is different. And one of the things that we are proud of is that at a time like this, when the industry has had some down quarters and has come from some of the biggest years, or the biggest years in the history of mortgage banking, and come crashing down to 2023, which was really a lousy year by any measure, is that we have the resources to stand firm and stand tall in Washington on behalf of our members when they are struggling and need our help the most.
So in business and in mortgage banking, I feel like it's so easy to make the assumption that everyone's a core KPI for any leader is growing revenue or growing profitability and margin. And I know there's a lot of other KPIs that we all manage to here in the private sector. But how does, like, when you think about running a trade organization, how do you measure success if you're not necessarily measuring to a revenue or a profitability number? Maybe you are. I'm kind of like, how do you set a North Star in terms of, hey, as CEO, I got to accomplish this? Like, what do you measure?
Sure. And Clayton, on behalf of my mother-in-law, who I might make listen to this, I'll tell her that KPI is key performance indicator. And you're absolutely right that as a nonprofit, we need to be sound financially, but we don't need to make an operating profit every year. And we're blessed at MBA to have a very significant operating reserve. We could keep this thing going for an awfully long time with no revenue, and continuing spending our expenses as we do. In any realistic situation, revenue would drop, not go to zero, and expenses would drop, not stay flat. So we're in a very fortunate position. But that does mean that in some years we go to the board and say, we're going to run a slight operating deficit this year. Here's why. Here's how long it's going to take for us to reverse things. And here are the kinds of things that our members need us to do for them, even though it's not going to be a profitable year. In other years, we have pretty significant operating profits. So you're right. It's not just that I'm running MBA to make a bigger operating profit every year. We have a scorecard that includes things like, how do the members of our policy setting boards, RESBOG on the single family side and COMBOG on the commercial multifamily side, how satisfied are they that we are tackling the right policy and advocacy issues on behalf of their segment of the industry? And are we effective in creating the change that's needed to let our members be effective serving their customers? And we have all sorts of other metrics that include a great deal of member feedback, so that I said from the day I started here, the MBA's priorities are not Bob Broeksmit's priorities, they're our members' priorities. And so we try to align the scorecard with that so that we get good feedback on whether we are delivering value for our members, no matter where we are in the cycle.
So as a former practitioner, I think it's hopefully pretty easy for you to understand the objectives of the board and the members. How do you bring along your organization in understanding the objectives of a mortgage banker and help all the team members? And some of them I know have been at the MBA for decades, so they get it fully. But if have someone that's earlier in their career, newer to the trade organization, how do you help them in training and coaching, come along with understanding this nuanced and complex industry that we both serve?
It's a great question, Clayton, because it's one that was particularly acute during the pandemic. And if you figure just in round numbers, let's say your turnover is high single digits or 10% in a given year. And with 160 employees in 2 years, you might have 25 or 30 new employees. And during the pandemic, when we weren't seeing each other very much, you woke up one morning and said, geez, I don't even know some of these people's names because I've never seen them, right? And how do we make sure that they understand why we do what we do, which is a really important part of our employee culture. So it takes having me and all through the organization, but of course, I think the tone at the top is important. Explain regularly how what we do affects everyday Americans. And I think that's what really binds people to this mission and to this place, is that it's not just a job, it's a way of doing good for society at large. So every step we take, whether it's a certain training course that we're offering or a certain panel at a conference or whatever an advocacy thing on the Hill, whatever it is, we try to let the whole association know in English, not in mortgagees, here's what's at stake, here's why we're doing what we do, and here's how, of course, it can benefit members, but we always try to put everything in how it benefits the customers our members serve and America at large. And then people can really start to piece together their little part of what they do for this association and what we do as a whole in delivering for the American people. So it's really a privilege to sit in this chair because I can't think of a single thing that we do here that I can't relate to our everyday MBA employees and team members and say, here's why it's important and here's how it's going to help this country.
Yeah, I mean, the mission side of housing is so clear. And I mean, I see it inside of our team as well, like thinking about the fact that as housing professionals, we serve the largest segment of the U.S. economy, and arguably one of the most important segments that has downstream impacts and health and education and financial wellness. Like housing is so critically important. So that mission usually comes across loud and clear. And most of the people I talk to that work in this space or are new to the space.
Everyone can relate to it, whether they put themselves in the position of when they were kids and maybe their parents bought their first house or they had the place where they made memories, or whether it's when they came of age and they bought their first house, or it's really gratifying. Of course, some of our younger associates, they're buying their first houses now. And so everyone has an experience that's deeply personal about this. And I think it makes it easier for them to extrapolate for the whole country about, oh, gee, here's why when we send Bill Kilmer and his team to Capitol Hill to lobby for this provision or that it really makes a difference in making it easier to achieve the American dream.
So in your time leading the MBA, you've led a team through multiple eras or seasons of the housing economy. In that 18-19 period, we were in that insane margin compression era where people were feeling pain for one reason. Then we went into COVID. Then we saw the COVID acceleration and low rates, and we saw rates shoot up. Like, how has your leadership style and coaching approach changed with your internal team as the industry and the members you serve have, kind of had to flex in many different directions? And, there's the good days and bad days. I'm curious how you help the team kind of mirror or adjust to what the membership is feeling or going through.
Sure. And I think one of the main parts of it is that we try to focus on areas that we actually, control may be too strong a word, but at least can influence in a positive way for the benefit of our members and all of the customers they serve. So when margin compression, as you mentioned, in 18 and 19 were happening, and we had some quarters where the average independent mortgage banker, for instance, was losing money, we set about to think of ways that we could help reduce costs in the industry. And frankly, our record of the industry as a whole has not been fabulous in that regard, because our research indicates that the average cost to produce a mortgage loan has gone up and is in five figures now, over $10,000, which is not where we want it to be. But in some cases, it's because of some perhaps well-intentioned regulation. And you know how it is. You have checkers checking the checkers to make sure that every loan is TRID compliant and ATR compliant. And we're producing the best paper we've probably ever produced as an industry. And we have delinquencies at a 40-year low, but the cost to manufacture them has been quite high, which is why when the pandemic hit, we went from having margin compression to absolutely existential issues for this industry. it was a very stressful time, but a heady time, because we knew that we knew what the solutions were as the world closed down, right? You had a situation where appraisers didn't want to go into strangers' homes, and Lord knows the home sellers didn't want strangers tromping through the house. So how do you appraise a property when nobody's allowed to be anywhere near each other? And how do you get loans recorded and title transferred when the county clerks are closed? And how do you have loan officers take applications when there's an on-site requirement to work out of a licensed office? And the list went on and on. But with our great team here at MBA and our relationships across government and industry, we would convene with FHA and VA and USDA and Fannie and Freddie and FHFA and the whole alphabet soup and say, look, in order to have this industry close a loan tomorrow, we got to fix the following problems. And then we'd knock them out. The cooperation, public, private, government, was really impressive, I thought. And then the next day, like whack-a-mole, a couple of other things would come up, and I left out the biggest of all, which was convincing the Federal Reserve that if they didn't step in and buy mortgage-backed securities, and what was it, the end of March 2020, there wasn't going to be a single lender able to publish a rate sheet the next morning. I mean, I don't know how you get more existential than that. And then when they perhaps over exuberantly bought MBSs and the margin calls on pipelines that were going to be vastly profitable, but weren't profitable yet because the loans hadn't closed. And then the counterparties on Wall Street were saying, you owe me $24 million by 8 tomorrow morning. And we had so many lenders on the brink of insolvency, only to have their most profitable months and quarters to follow. So it was a real roller coaster ride, but I couldn't be prouder of how the team at MBA and our members came together with all the decision makers to, one by one, knock out all the impediments and make way for the biggest 2 years in mortgage lending history. And more importantly, I view the mortgage business as the conduit for the essential relief that the Fed was offering in terms of lower rates. But Jay Powell waving his wand and say interest rates are zero does not lower a single person's mortgage rate. It takes MBA and its members to bring that relief and stimulus to each borrower and then to the economy as a whole, and then see us, come roaring back from a once in a lifetime, I hope, pandemic.
Yeah, I mean, I've had guests on this show who run big mortgage lenders with big refi components of their business, and I think there's often a tone in different market segments where the industry wants to talk about who's the leader in purchase and who's the leader in refi. And I know the capital markets haven't looked too favorably upon refi heavy lenders, but at the same time, this was I guess it was Anthony Shea in 22, said, hey, if we didn't do a ton of refi, every single one of those loans that we didn't do is someone who didn't get to take advantage, a homeowner who didn't get to lower their rate after Jay Powell waved that magic wand, which is now we bring this back to the mission side of the industry of hey, what can this industry do to actually impact the American homeowner? I think that was a great example of it. No matter how painful it was at times and how painful it was when headcount needed to be lower on the other side of the refi wave.
Right. And not to mention forbearance, which was, talk about a heady time. We had the Congress about to pass effectively emergency legislation that would have saddled the industry with an absolutely impossible forbearance regime. And we had our staff on the phone with House and Senate staffers, literally rewriting a bill that the leadership had said is past the time for revision and was going to go into effect. And that led to the forbearance regime that we ended up implementing. And I don't know if you can think of a better public-private partnership on delivering effective relief overnight, and maybe over a couple months, but effective overnight, right? At a time when all of our servicers were sending their employees to work from home, which maybe they tried once in a tabletop exercise or something, but nobody did that, if you remember, in 2020, and then everybody did it at once. And while occasionally you'll hear the story of somebody who wasn't handled perfectly, by and large, it was just a great success. And to the point where, a lot of the conversation in Washington now is, well, how do we have that tool available when needed, as opposed to only in the time of a national emergency?
Bob, so what do you have to do as a leader to ensure you have a seat at the table and a voice in the conversation when the Fed is considering buying MBS or we're writing a forbearance legislation? Like, what is the pre-work that goes in to like having that seat? Because I know it doesn't happen by accident.
Relationships and credibility built up over time. And what I mean by that is that we have to be seen as the source of true and right data and observations about the mortgage industry. There are times when there are issues that come up that are troublesome to us and to some of our members. And we have to be careful that we don't go to DEFCON 3 with everything, so that when there is something that is really critically important, that the people on the other side of the table say, well, if the MBA is making a ruckus, this must be a real problem. And then we retain our credibility. They come to us for solutions, and we get together with them and say, all right, I like where you're going, but you got the right idea, but completely the wrong approach, and it'll never work. But if you make this tweak and that tweak, our members can actually deliver it. And that's how good, enduring policy is made that helps not only our members, but all the consumers, because the landscape is littered with great ideas and crappy implementation plans, right? And so our member-driven focus leads policymakers to know that if the MBA says it'll work, it'll work. And if the MBA says it's not workable, and I'll give you just one quick example on the debt to income loan level price adjustment, we said to FHFA, that is unworkable. We said it over and over. We made it really clear, and lo and behold, they scuttled it. And it wasn't because they didn't think that maybe that wasn't a bad risk management idea, but when the MBA says it's unworkable, they realize and recognize that it's unworkable, and we move on to other things.
So it's a brutal exercise in prioritization. How do you manage, like, I'm sure you have members and board members who, might wave their hands about an issue. And there's times where you have to say, hey, there's something else on the horizon where our energy needs to be, or we need to like keep the bullets in the chamber for this one. Like, how do you manage that like prioritization?
Well, you're right, Clayton. That is an important part of the job, balancing all those demands. And what we try to stay true to, because as you know, we have a wide variety of business models and sizes within MBA's big tent, and it's one of our great strengths, but it also makes things a little more complex. So we try to advance the mortgage lending ecosystem for all participants. And there may be times when the issue that we're advocating might seem like that's the big banks' top priority, and that the IMBs and the credit unions and the community banks maybe care less about it. And vice versa, it might seem like the top IMB issue, but the banks aren't as engaged in it. But when we can get down to the point where we say mortgage lending will be better for the consumer if this policy is enacted, then everybody can rally around and say, okay, well, maybe it's not my top one today, but we see why that is the top priority for MBA. And if we stay true to that discipline, then I think over time, members will see that the mortgage business is better for everybody. And that's how we try to keep things in perspective.
From time to time, I see the organizations kind of join arms with other trade orgs like National Association of Home Builders or Consumer Bankers or NAR. Are those relationships an opportunity to kind of like have someone else help you carry the water for something that might not be your top priority at the moment? Or how do you manage that? Like, is there a cross trade org like collaboration that like helps get the right priorities prioritized?
Yeah, and I would say that that's one of the features of my time here at MBA is to join arms with other trade associations who have an interest in housing and housing finance. And I learned that lesson early on when there were issues on Capitol Hill where we heard from members of the House and Senate that they didn't think that the housing industry was aligned, and it gave them an excuse to do nothing or do what we would consider the wrong thing, and how important it is that we speak with one voice on important issues. So we agreed, and we have a large coalition of trade associations that we work with depending on the issue. But we have the realtors, the home builders, and the American Bankers Association, along with MBA. We meet regularly, the CEOs and senior staff, and we agree that on housing related issues, we're going to have a united front. And if there's a time when we can't, we're going to have that disagreement behind closed doors. We're not going to go to Capitol Hill and one lobbies for one thing and one lobbies for another, because that is a sure losing formula. You're either going to get no action or you're going to get the wrong action. So yes, there's some very formal relationships and interplay between the associations. There's less formal, like going and getting a drink with another CEO, that kind of thing. And we do try hard to present a united front. And sometimes you'll see maybe MBA leads a letter to Congress or a comment letter or something, and you'll see other organizations on it that amplifies the message. And then there are other times, as you mentioned, if it's not our top priority, but it's important to some of our members, maybe one of the other trades leads, and we sign on.
Really interesting. Okay, so as we run into 2024, and we just came out of the New Orleans IMB conference a couple of weeks ago, you got servicing ahead of us. How are you thinking about top priorities for 2024 to support the membership?
Well, as I mentioned at the top, we do feel as though 2023 was the bottom in a lot of ways. You saw existing home sales were the worst they'd been in almost 30 years. And the question becomes,
at least our year-over-year measures are going to look better.
Yeah, right. And the question is, do we bounce along the bottom for a while, or do we have a nice slope to the recovery? And as everybody knows, the real wild card there is supply. We do think that the lock-in effect is real, but we also think that every quarter that goes by, there are a couple of dynamics going on. Life events happen, and if you've had another kid and the house is too small and you don't have the energy or the room or the permits or whatever to blow out the kitchen and add a family room or whatever you need to do, you are going to buy another house. And the expectations that you might have had a year ago or a year and a half ago, that you can't buy at the peak time for rates and they're going to go back to 3%, I think that fades into the rearview mirror. And you have had a nice, 110, 120 basis point drop in the 30-year fixed rate. And I think a growing understanding that if you find the right house and you can afford it, buy it now and refinance it when things inevitably improve a little. So in other words, it's not a lack of demand, it's a lack of supply. And I think we're forecasting about a 20% increase, 25% increase from $1.6 trillion to $2 trillion, which won't be a great year, but it'll be an upswing, which I think everyone will benefit from.
So focusing in on making sure lenders are prepared to serve this 20% increase in demand in 24 is a top priority.
Yes, and I think most lenders would agree with you that even though they've been through painful cuts, the industry still has the capacity to do more loans tomorrow than it's doing today. And I forgot to mention, you mentioned at the IMB conference we just had in New Orleans. I'll tell you, it was really interesting because, of course, you got to plan pretty far ahead for these events. And given how bleak things were in the market, we budgeted for a 30% drop in paid attendance at IMB, and we ended up with a 7% drop. So that's, I think, some indication that there are green shoots out there. The drop in interest rates has helped, and that people are optimistic. Of course, there has been consolidation. There will continue to be, but the people and companies that are still in the space are optimistic that things are going to improve. And then for our servicing convention in Orlando and Florida, we're excited to bring that part of the business, which has fared better, as you know, than the origination side. And for some lenders, that has been the silver lining in the cloud, that servicing values have held up nicely, prepayments are very low, and that counter-cyclical piece of the business is working when originations are soft, servicing is strong. And we're looking forward to welcoming Scott Pelley from CBS, who just had the interview with Jay Powell the other day, and he'll be joining us in Orlando, and we expect to have lots of good content for our servicing friends down there.
Yeah, servicing has been such an interesting area to watch over the last three years or so, and that recurring revenue or counter-cyclical component was so valuable for some of the IMBs as they kind of left the heydays of 21 and beginning of 22 into a harder environment. But we did see a lot of IMBs start to sell and release that servicing to access cash over the last 6 or 7 quarters. What do you think the tone's going to be at servicing? Do you think people are going to be talking about retaining more, continuing to sell? Like, where do you think mortgage banking leaders are thinking about, like, how they want to leverage the value of servicing rights and the time frame, I guess?
Sure, and I think the dynamic you mentioned of uh, IMBs selling some seasoned servicing in bulk, that's always part of the calculus for IMBs, and there are some tax reasons why holding servicing for a certain period and then selling it makes sense, and recognizing the value. As you know, mortgage servicing rights are um, they can be a pretty volatile instrument, right? And you when you book it, you book the MSR for the expected life of the loan, and then if the loan pays off, you have a nasty income statement event where you have to write it to zero, and that makes the recapture point that you made all the more important, because if you can replace it with a new MSR the next month and retain that borrower, that's great. And if you don't, it's kind of a painful financial exercise. So always looking out and maximizing that asset and saying, all right, well, I've held it for a certain period of time and the market is strong and I need to trade in an intangible asset or let's just call it a paper asset for real green dollars, because my origination business is breaking even at best, maybe losing a little. And if I don't originate, I don't have servicing. So it's all part of the calculus for lenders and servicers. And so anyway, the I guess my main point is that it's a calculation that each operator makes. What they will do in 24, I mean, in some cases they'll say, geez, if the Fed's going to cut a few times and rates are going to drop, my MSRs will probably never be more valuable than they are today, because in a falling rate environment, prepay speeds will go up. And if I can get cash on the barrelhead today, I'm going to take that. Others will say, hey, look, it's just an opportunity to replenish a seasoned MSR with a new MSR, and I'm good at retention, and that weighs into the calculus. So it's all part of our highly complex and dynamic industry as operators go through these decisions.
Yeah, Bob, at IMB, one of the conversations that I heard many times, kind of not on the main stage, but kind of in the conversations in the lobby and restaurants and bars afterward, was about consolidation and like a people looking for scale and the comfort and safety of scale in the mortgage banking arena. How are you thinking about like some of the strategic actions that mortgage banking leaders may take in 24, and like if you're anticipating an M&A or consolidation wave? I'm curious to how you think about that, relatively important industry trend or not.
Sure, I think it's been really fascinating to see how some lenders are focusing on particular distribution channels. For instance, you might see a lender say, I'm going to focus exclusively on retail.
Yep.
You might see another say, I think wholesale really has got the best dynamics for me, and I'm going to go all wholesale. And so I think that's really interesting because you see some lenders make completely opposite decisions on the same day or the same week. You read about these changes. And I think that it makes sense to play to your strengths. I think that some have built really good capabilities in retail. Others say, geez, as long as we're paying loan officers what we're paying them, and everybody always says the first person to normalize LO comp is the first one to go out of business because all their loan officers will flee to a competitor. And some say, gee, in that model, for the long term, I don't think that's where I should devote my capital and my resources. And others say, I kind of like the cost dynamics in the wholesale business. And some of that work is done by the broker, and I don't have to flex up and down quite as quickly, and my compensation dynamics are different, and I think that's the way to go. And the other thing I would add, just when you think about consolidation from a macro perspective, every transaction is a personal and emotional decision for the owner of the entity who considers selling. And it's, in many cases, it's their life's work, and they've poured all of their passion and energy and finances into it. They probably made a pretty good profit in 20 and 21, and some of them are sitting there saying, can I slow the bleed until the business improves? And others are saying, I'm not going to give back everything I made in those years. But a lot of them, their identities are so deeply intertwined with their companies, and they can't say, okay, well, times have been tough for a couple of years, I'm going to get out. And there's not a lot of buyers writing enormous real green money checks to entice them to do it. So I think that that's part of the reason that consolidation has been a little more slow than some had predicted. So we'll certainly continue to see it, but I don't think that there will be a mad rush to exit this business as you see things starting to look up.
Yeah, I just did an episode last week with Scott Ludden from Sterling Point, and he was talking about, not a lot of buyers, writing those green checks. We talked a little about the trend in seeing more mergers where, like, there's not actually cash changing hands, but like combinations that bring scale. But then you bring in that seller or leader psychology of like, hey, there's going to be likely one CEO or leader who prevails in this merged business, and am I ready to either step into a production leadership role, because I think most mergers want both leaders to stick around in some capacity. It's a psychological decision when you've been an entrepreneur and had the top seat for such a long period of time, in the case of a lot of IMB operators.
Right. And I think in many cases you will find a good marriage where the proprietor of the selling institution says, well, I can have a transitional role for 2 or 3 years and probably have some sort of earnout and try to make the new situation as good as it can be for all of my people, because they're not just making decisions for themselves, they're making decisions for people who worked with them and helped them build the company. And perhaps taking, as you suggest, a senior production role that makes it more likely there will be an earnout, first of all, and secondly, gives a good situation for as many of their people as possible. And maybe you're approaching an age where retirement doesn't sound like the end of the world, and then those combinations work really well. But yes, it does add a layer of complexity if it's somebody who has a long runway left and wants to stay involved and stay in the top seat. That can certainly complicate things.
Well, Bob, I can't thank you enough for joining us for this episode of Powerhouse. Loved hearing about your approach to leadership inside of your organization, but it comes through really clearly how you think about leadership in the industry. And there's a lot of places where this industry, housing finance, needs more leadership. And this conversation has been a pretty good reminder that of how many twists and turns we've had in the last 6 or 8 years. Like, mercy, there is not really like a quiet period in mortgage lending, is there? It's always one fire to the next.
Well, that's absolutely right, Clayton. And when it does get quiet, appreciate it, because tomorrow the proverbial S is going to hit the fan.
Well, I'm glad we have you in DC advocating for us housing professionals across the U.S. Bob, thank you. Look forward to doing it again.
My pleasure, Clayton. Thank you.